Hi everyone, this is Abhay Agarwal from Piper Serica. This is our regular monthly update for the month of August 2025 about the general conditions at the markets and where are we seeing opportunities, where are we seeing risks, as well as how's the portfolio doing and any changes that we have made to the portfolio. So first of all, global markets, as you would be reading, you would be aware, the Trump tariffs started to come into effect last month, and India bore the brunt of it with 25% tariffs general and then penal 25% tariffs on top of it, taking it to 50% tariffs for all exports from India to the US. And the reason being that India has not stopped buying the Russian oil. Now, while some of it would be political positioning, posturing, the reality is that the tariffs have come into effect. And even though in a small way have started impacting some of the industries that depend on exports to US, like textiles, some of the food products like shrimp farms and gemstones, jewelry. So these are the sectors that have traditionally depended on the exports to US, and they are finding it difficult right now, including some autocom companies, to sell to the US market because the US customers are very wary of the stickiness of these tariffs for the time being. While there is expectation that things will resolve themselves and these tariffs will go away, I don't think the US buyers are right now willing to commit to that. So definitely some stress on some sectors. However, the silver lining is that this has given the government an opportunities to push the reform agenda, starting with GST rationalization. So on the day of the Independence Day celebrations, the Prime Minister said in his speech that GST reduction and rationalization across the board will happen pretty soon. The GST Commission meeting is there on 3rd and 4th, tomorrow and day after. So the expectation is that with the rationalization of slabs, 18% slab going to 12% and 12% slab going to 5%, a lot of products will become cheaper for the Indian consumers as the GST rates go down. And at the same time, uh, the government will hopefully make up for this GST shortfall by increasing consumption and increasing volumes. We're already seeing GST collection by the government go up month on month basis. For the last month, the government collected 1.86 lakh crores, which was a 6% increase over the same month last year. So we also believe that whatever are the GST cuts, they will not lead to any material shortfall in government revenues and will be made up by increasing consumption, which is exactly the focus that the government has right now. So I think the tariff threat has also exposed that nobody is a real friend of any country, and each country has to fend for itself as far as its own economy is concerned and has to make policies that are favorable to its own population. So I think India is squarely there now, and some of these reforms are going to be very material in boosting India's domestic consumption and as a result India's export competitiveness over the medium and long term. There will be small hits. We saw a market correction last month that thankfully didn't last long. The Nifty was down just about 1.5% last month. But the rupee has depreciated to an all-time low of 88 rupees, which is still not very bad against the US dollar because it's just about a 3% depreciation this year. But at the same time, the rupee has depreciated a lot more against currencies like euro, yen, and the pound sterling. The correction over the last 1 year is 12 to 13% against these currencies. So I think a big inflow of foreign capital into the country is required to boost the rupee and to stabilize it. RBI has been doing its role, but I don't think rupee can find its real level till the market forces are allowed to come in and play in full. At the same time, we are not expecting any sharp decline in rupee from here on. Rupee is about 88. I think it can slide down to maybe about 89 level. but I think most of the correction is done for the time being. The Indian bond yields have gone up slightly. From 10-year is at 6.6%, from about 6.3%. But we are expecting another rate cut in the next policy announcement by the RBI in October. So I think that should bring down the rates. There is no shortage of liquidity in the system. The private capex seems to be getting started. There is an expectation that the consumption in upcoming festive season will be very robust. We already saw the recent sales that happened in Independence Day, saw the e-commerce websites, portals recording their highest ever sales. So I think the domestic consumption is pretty strong. Private capex has started to kick in. Government has done its bit by reducing GST rates, reducing income tax burden on the earners, and also RBI has done its bit by reducing interest rates. So all in all, I think the market correction, if any, will give another opportunity to long-term investors like us to invest in some amazing growth companies. On the portfolio side, you would have seen we have been selling our position in CMS. We added CMS about 3 years ago, and it has done well for us. It's more than doubled in 3 years from the time we bought it. The reason for reduction in the allocation in the model portfolio is because the company is struggling for growth now. I don't think they will be able to meet their growth guidance of 15% per year for next 3 years. And after some pretty detailed research, we have decided that this is one stock that may pull down the portfolio returns. So to increase cash in the portfolio for new buys, CMS is one stock that we have been exiting. We have also exited and close to exiting our full position in Suryodaya Bank. Again, we believe that while other banks in the portfolio have done well, this is a bank that is still kind of struggling to get out of the bad credit cycle that the whole industry went through. The objective of selling these two is to create some cash in the portfolio, because there are two ideas that we have been working on, two growth companies, and we want to add them this month. So this cash that we have generated, about 10% in the portfolio, will help us add these two companies. So I think to summarize, the markets are kind of consolidating at this level, looking for new triggers to go up. And at the same time, it is good to see that all the bad news, especially related to tariffs and rupee depreciation, have been absorbed by the market, largely because the domestic institutions, retail investors, have been very supportive of the Indian markets, even in face of pretty aggressive selling by FPIs. But we have seen this in the past also, that FPI selling reverses. It becomes a buy, because India again is a market that is going to be very difficult for foreign long-term investors to ignore for the next 10 years. So any bout of selling, any market correction will be a great opportunity for investors to continue to invest. We still believe, and we continue to believe, that Indian equity will outperform all asset classes over longer periods of time. So I think where we are happy to look for opportunities. There are plenty. We need to search for them. Growth companies are overvalued in pockets, but at the same time, there are opportunities that we are focusing on. So you will see those names getting added to the portfolio this month. And when we come back to you next month for the monthly update, we will share more details about these companies. So thank you very much for your time.